Hello, everybody, and welcome to VRIC Media, your most trusted voice in metals and mining. We are bringing the VRIC to you each and every week with our series of expert online panels. I'm very excited for the one we have lined up today. This is two gentlemen who've been on the program a few times before, but it's a real honor to get them both together on the same episode. We've got Steve Hanke, professor of applied economics at Johns Hopkins, and Michael Pento, president and founder of Pento Portfolio Strategies. We're going to discuss the effects of Trump's tariffs, the current state of the broad market, whether it's finally headed for a major correction, $3,000 gold, and so much more. Gentlemen, it is great to have you on the program.
Great to be with you, Jesse. Thank you.
Always a pleasure.
Well, let's start off with discussing Trump's tariffs and the current U.S. economic and fiscal policy as you both see it. Obviously, these tariffs have been very contentious, particularly in my home country of Canada, where they have literally caused masses of people to gather in protest and wave the Canadian flag. Somehow, this is now Canada's moment to come together after their own politicians have been ripping them off for years and subjugating them. Now, Trump's tariffs, this is the moment to stand up because that's somebody over there, which I find rather amusing. You have some people defending the tariffs. You know, you talk to some people who believe this is what's required to return production to America. We've outsourced our production to places like China for far too long. We've hollowed out, the economic engine of America, and these tariffs are the way to bring it back. And then you have people on the other side of the aisle who say they're just very poor policy and they're just divisive. They're going to cause problems and they're going to hurt Americans most of all. I wonder where both of you stand on the issue. Steve, I'll start with you.
Well, just narrowly focusing on the tariffs, they're a complete disaster. Sanctions are a disaster. Tariffs are a disaster. Quotas are a disaster. Non-tariff barriers are disasters. All these things are interfering with free trade, and so they're by definition just disasters. So and always end very badly, by the way. But if we look specifically at Trump and his thinking about this, Trump is basically a mercantilist, and he thinks like most businessmen do. They think the economy should run like a business, and a business, of course, a business you have to have a surplus. If you run a deficit for too many years, you're going to go bankrupt and be out of business. So there's what's called a fallacy of composition. You can't take from the small and exaggerate it into the big aggregate, and a lot of times it's just different. So what you have is obviously Trump thinks and claims that deficits, international trade deficits, current account deficits, that he thinks are bad, and he thinks they're also caused by nefarious activities of foreigners. Foreigners are causing this, not they're not caused by anything going on in the USA. In fact, trade imbalances are always homemade. They're caused by what's going on with the relationship between savings and investment in the home country. And in the United States, we've had trade deficits since 1975, and we have them because we have a savings deficiency. The savings is a lot less than investment in the United States. And that's not a bad thing at all. It's actually a good thing because we can finance those deficits quite easily, by the way, and cheaply, because we have very thick capital markets. Basically, the only thick capital market in the world is in the United States, and we have the international currency. So everyone wants it to get into dollar-denominated debt and U.S. equities all the time. So it's very easy to finance the deficit. So we end up with the whole premise that Trump has. If you look at the economics of it, it just stands the whole thing on its head. Deficits are good, and they're made in the USA, and they're good because it's easy to finance them. Now, for the U.S., That's not the case, by the way, for other countries. Many developing countries get into problems where they have big trade deficits and current account deficits, and they can't finance them easily. And they have what we call in economics a sudden stop of the capital inflows, and you have one hell of a currency crisis on your hand and a big problem. We don't face that in the United States. So basically, the premise behind Trump's thinking is just complete nonsense. It's utter rubbish. And the policies, by the way, will end in disaster, not only for foreigners, but there's something called the learner condition. And the learner condition is that tariffs are in fact a tax, but who are they a tax on? There'll be a tax on American exporters. That's the way it works. So the real damage is going to be to American exporters.
Some great thoughts there, Michael. How do you see it?
Well, first of all, Mr. Hanke's obviously more intelligent than I am, because look at all those books that he read behind him. I don't have any books behind me, but I'll say this. I think the implementation of the tariffs have been terrible, but the idea to rebuild America's middle class is a great idea. I think the prima facie evidence that we have a $131 billion trade deficit for February, I think that's disgusting. I think Mr. Hanke said how wonderful it is, but when you think about national security and not having our own infrastructure and not having our own bolstered middle class is a terrible idea. So what happens with a trade deficit, the idea of trade, and again, I am a free trader, but I believe in free and fair trade. And manufacturing as a percentage of GDP has plunged throughout the decades here in the United States. And the reason for that, I believe, is we've just outsourced our production to cheap labor overseas. I don't think that's a very good idea. So the implementation has been terrible, but the idea that we should have a very strong middle class and national security is a wonderful idea. I'll try to keep my answers a little shorter than Mr. Hanke's. But when you think of international trade, I think of trade in this very old-fashioned way. The U.S. produces some good and then exchanges it for goods or services in another nation. That's trade. Trade should never be, I print dollars and send them overseas, and then you recycle those dollars back in what is a capital account surplus, and then you own little bits of our country, our stocks, our bonds, our infrastructure. So we're selling away our country bit by bit. And what is this trade deficit? It's a tax on future production. We owe the future production of this country to foreigners. It's a very bad idea. So I'm all for a balanced trade, a capital account and trade account balance. I'm all for that. Again, the implementation has been horrible. So reciprocal tariffs coming April 2nd, if that's the way that's the tactic we're going to take, I'm all for that. Let's stick to it so businesses can understand what these tariffs will be. But again, rebuilding America's middle class is a wonderful idea.
So, Steve, do you think reciprocal tariffs would also end in disaster? And any thoughts on what Michael has said?
Well, for one thing, he said a lot of things that aren't correct. One is that manufacturing as a percent of GDP has gone down. Our manufacturing has actually increased. The employment in manufacturing, of course, has gone down, but that's due to the fact that productivity has gone up. So that's one little premise. Again, it's not correct. I'm all the middle class, whatever the middle class happens to be. It'd be great to, as you say, it's a great slogan. Who's against making the middle class richer? Let's talk about what's been going on in the last 4 years in the United States, a little over 4 years, actually, since the pandemic in February of 2020. The money supply was goosed by the Fed. The federal government accelerated expenditures enormously with the onset of the pandemic and the lockdowns in the United States. At that point in time, February 2020, billionaires' wealth as a percent of GDP was 14.1%. Today, as a result of all this money being pushed into the economy, now the billionaire's wealth as a percent of GDP is 21.1%. So forget the middle class. We've been following a policy that has been a complete disaster for most Americans, with the exception of the billionaires. It's the top 1% that's gotten rich, so that the income distribution has become much more unequal in the past 4 or 5 years in the United States due to all this government intervention. So the middle class is it's a BS slogan. The fact of the matter is the rich know that either you run the show or the show runs you, and they run the show in Washington, D.C. Now, as far as the reciprocal tariffs, we have a long history of reciprocal tariffs. One of the books in back of me, Michael, is a thick one, which is up on the top shelf. I'm not going to get it down. The history of tariffs in the United States, and something called "Beggar Thy Neighbor," 1937. Joan Robinson, famous Cambridge Don, came up with that phrase. And what Robinson enunciated and had been proven true to that point in 1937, it still holds. Beggar thy neighbor is if you put a reciprocal tariff on somebody, they counterpunch. So it just goes from one thing to another. Put a tariff on, counterpunch, 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 on and on and on. And it's a way, actually, it's a formula to make the middle class poorer, not richer. Tariffs do nothing for the middle class whatsoever except make them poorer. That's the empirical evidence.
Well, Michael, I'll give you a chance to respond here as well, and then we'll move on to the next topic.
Actually, the percent of GDP after World War II was about 27%. Now it's 10. So that's just a fact. I'm correct there. I'm not a big fan of tariffs, but again, I think you said you get into this, death spiral of counterpunch. But listen, it's never been more unbalanced in this country. The bifurcation between the rich and the poor. I blame the Federal Reserve for that by falsifying the cost of money and by expanding this balance sheet by $8.3 trillion since the global financial crisis. That's laid at their feet. But we've become a financialized nation, and we're just living off asset bubbles, and we have hollowed out our manufacturing base. That's a fact. That's not debatable. And you can't have a viable nation without a viable middle class. It's not a slogan to me. It's crucial that we can't just have the poor living off the government and the rich living off asset bubbles. That's what we have in this country. So I'm all for bringing back manufacturing and for balancing our trade, 100%. It's a matter of national security and for the existential concept of the USA.
Yeah, now another thing with tariffs and the kind of regime uncertainty that's being created by these tariffs that have either been imposed or threatened by Trump is that it's going to put a big dent in profits. Now, profits are actually important because middle class savings come in their 401ks and they're invested in the stock market. And the stock market, of course, is going to face some headwinds because the consensus right now for the profit projections in the United States in aggregate for this year is 15%. I think it probably will end up closer to 5% growth in profits. So we're going to see a big change. The tariffs and that regime of government intervention coming in is going to put a big dent in profits. And when that happens, the stock market is not going to be sailing very fast. It's going to be going into reverse.
Well, on that we agree. I think we agree that it's actually not 15, it's closer to 13% now, year over
Well,
year.
Bloomberg's is 50.
Earnings growth on the S&P 500. So you're not going to get, in my opinion, you're not going to get 13% EPS growth in the S&P 500 in a regime of 1% or less GDP growth. I don't see that happening, especially when there's no change to the tax level. So we agree on that.
Well, I think that's a good segue into discussing the broad market a bit more in depth. We see headlines every day that the market's going to crash by 50%. I mean, that's one of the most common things I see when it comes to YouTube videos looking for clicks. And every time a small correction occurs in the big indices, social media is abuzz. You know, here it comes, the market's about to crash, the new Great Depression is here. How do you both currently see the state of the S&P, the Nasdaq, the Dow Jones, those big indices, the Mag 7, and the exuberance that's been behind them that many would call irrational? How long can the market carry on like this? Because from my perspective, it's overvalued by so many different metrics, but I'd love to hear what both of you think. Michael, I'll start with you on this one.
Well, I'm one of those people who say that the market needs to correct by 50%. I didn't say it was going to correct or give you a time frame. I said it needs to correct by 50% because if you look at the total market cap of equities as a percentage of GDP, it's just about 200%. The mean over history is closer to 85, 90%. So simple math there. It's a 50% correction. If you look at the price to sales being at 3 with the mean about 1.5, if you look at the negative equity risk premium, which is a very rare phenomenon indeed, a record allocation to equities for households. Investors have a record allocation to equities. Yeah, it is a bubble. It needs to correct. And the $5 trillion that was printed post-COVID that ended up piled up in excess reserves and in the reverse repo facility, that's gone now. So you have about 400 or 500 billion left in the Treasury General account. The reverse repo facility is just about dry. There are some excess reserves in the system, yes, but they're coming down. The Fed's balance sheet has been shrinking. The level of the real Fed funds rate has been positive for a very long time. The yield curve was at the most inverted, second most inverted in history, and for the longest duration in history. It just now has normalized, which is also a sign of a recession. So we're going to have a recession, and that's when equities typically drop about 37%. I see no reason why this would be any different. It could be even worse. And yes, you can put me down as someone who's not, I'm not a Cassandra. I'm saying that recessions cause equity prices to plunge. I'm not saying that will drop by 80% like the Nasdaq did in between 2001 and 2003. I'm not saying that it'll drop by 50% like it did in 2007 or a specific period of time, but to bring the market back to fair value, it will need to drop by 50%. Now, it could also just stay where it is and have incomes and GDP rise. That's another way of doing it. But if you believe in mean reversion, I believe that, and nature believes that, and markets believe that, we will have to normalize that ratio somehow. And I think it's going to be a combination of what I just mentioned, dropping stock prices and eventually a return, a boost in incomes and GDP. Most of that work will be done on the reduced valuation of equities.
Steve, your thoughts on the current state of the broad market? Do you think that we're set for the same sort of dramatic correction that Michael sees there?
I agree with Michael's analysis on the market. About 3 weeks ago, before the market actually cracked, I wrote an article in Fortune magazine in which if you go back and look at that, I can't remember exactly what the title is, but basically what I put in the article was what I call, it's my bubble detector. I call it Dr. X's bubble detector. And the bubble detector reached an all-time high, actually, even higher than it was before the dot-com bubble. So Michael and I agree, we're in a bubble. The question is, how is the bubble? Is it going to pop, or is the air going to slowly come out of it? And how long will all of this take? The one thing we know is that eventually it's going to pop, or the air will come out of it, and the market now is just simply overpriced, overvalued, and overhyped. And kind of end of the story. I think Warren Buffett more or less has the thing right. If you look at Berkshire Hathaway, this last quarter he was at 27% cash, and he liquidated all their ETF, long ETF, market ETF. So that's I don't have much more to add except what I said. I mean, now whether it will be 50% or 30, how much and how fast and so forth, I don't have a good handle on that. Michael's much sharper on that than I am.
Well, Jesse and Steve, what bothers me most about this is, and we might talk about this in the next segment, but people are telling me all the time, but don't worry about it because the Fed's got your back. Well, let's just look just briefly through history. We had a central bank fully operational in the year 2000. I'm pretty sure on that. The Fed took interest rates from 6.25% to 1% rather quickly. Did that stop the NASDAQ from dropping 80%? Did that stop the S&P from dropping 50%? No, not at all. We entered a recession in December of 2007. Ben Bernanke took interest rates from 5.25% to 0% over the course of the next ensuing year. Did that stop the stock market from going down 50% or more in the S&P? I think it was 53 in the S&P 500. No. Did it stop home prices from dropping 33% nationally? No, it didn't. So, I mean, yeah, the Fed might have your back, but here's two things you might think about. Well, three things. Number one, I just proved that who cares if they have your back? They're always acting late in arrears. They always act late to the game. That's their method of operation. They don't know how their models are all broken. They're doing a stupid Phillips curve evaluation of inflation. It's completely broken and irrelevant to inflation. But let's just assume that they get around to cutting interest rates again. First of all, we have a problem now that we have never had since 1981. We have a problem with inflation. Inflation has been above the Fed's target for 4 years. Their asinine 2% target. They can't get back to 2%. And if you look at some of the things that, recent data that's come out in the ISM prices paid component, surging to multi-year high. So they haven't vanquished inflation. Inflation is still a big problem. So if you start to react proactively ahead of time, ex ante, to fight a decline in the stock market, the outcome could be a absolute revolt in the bond market, because for the first time in history, we have an insolvency issue here in this country. We have a deficit. The February deficit was 2 times the revenue. 2 times. So our deficits are running for the month 2 times what the revenue is. That's a very unique and rare phenomenon. $2 trillion deficits as far as the eye can see, and that's assumed that we get a huge tax hike at the end of the year when the Trump Tax Cut and Jobs Act sunsets. So what I'm trying to say is that do not be placated and think that the Fed has your back and can easily turn things around. It's not going to happen this time, in my opinion. You have a bond market revolution on the long end of the yield curve. You have an inflation problem. And the Fed is not going to act proactively. They can't. Their hands are tied. The Fed is frozen.
Steve, do you have any thoughts you'd like to add? Because I believe you have a bit of a different perspective in terms of inflation targets. Could you maybe talk about your thoughts on the Fed's 2% inflation target? Does that make sense? Is it just a random number? Is there a reason behind it?
Well, first of all, let me make a few comments about things that Michael said that I agree with, and then get off on a few things that I kind of disagree on. The first thing, this backside, that the Fed somehow has your backside. And Michael gave us a lot of good contemporary evidence, but remember, did they have the backside of the American public in 1929, 1933, when the market went down 86%? No. So we completely agree. Forget the backside thing. Now, the other thing, the other thing to forget is the is that they know what they're doing, and that they have models at work. They never predicted the inflation that we recently had, or the decline that we've had. And Michael's right. There's still in this old Phillips curve model with a little more fancy stuff added to it with post Keynesian models that don't even include a monetary aggregate. Now that gets down to where I'm coming from in terms of national income determination. The only thing that really counts is the quantity theory of money. Changes in the money supply eventually will transmit themselves into changes in asset prices, changes in real economic activity, and changes in inflation. And that's with long and variable lags. So if we look at what's happened recently, first the Fed gooses the money supply. We eventually get a lot of inflation. Then they panic because they're looking at contemporary data. They see the inflation's getting hot. They throw things into reverse. And since the summer of 2022, the stock of money in the United States is actually less today than it was in the summer of 2022. Now, that kind of contraction's only happened 4 times since the Fed was founded in 1913, Jesse. And each time a recession ultimately followed. Actually, one of the 4 times, the Great Depression followed. Remember, that was a big one. From 29 to 33, the money supply actually collapsed by 38%, and bang, we went down. So where are we with what's baked in the cake? In other words, this year, what happens in terms of inflation is something that's a function of what happened to the money supply a couple of years ago. And a couple of years ago, it was what? It was going down. So I anticipate that the headline inflation will actually come in at 2% or maybe even a little below 2% this year. And that doesn't have anything to do with other things going on contemporaneously in the economy. It's something that happened in the past with the money supply. Now, as far as the inflation target goes, the inflation target, remember, the Reserve Bank of New Zealand put in the inflation target formally for the first time, I think in 1991, if my memory serves me correctly, and it was 2%, and everybody else just copied 2%. It's an arbitrary number. I mean, if I was having a number, I'd have 0.
Yeah, exactly. Something magical about 2%. It's just the zeitgeist of central bankers. They all think the same. But like an economy can't function at 1.5% inflation. But a central bank was 1913 was created to have stable prices. Stable prices, in my mind, means 0% inflation, not 2. And certainly not 9, and certainly not 18 if you measured the inflation pre-Boskin Commission. That's what we had, 18, 19% inflation for several years post-COVID. So this is when the Fed was boosting home prices up 20% year after year, buying mortgage-backed securities all the way to March of 2022. Talk about an asinine model that really needs to be overhauled. So me and Professor Hanke agree 100%. There should be, if there's going to be an inflation target, it should be 0, not 2. How about having how about we lock the doors on the Eccles building and have the cost of money be a function that is based on free market? So the supply of savings versus the demand for money. And then we can make the base money supply, or high powered money, which the Fed controls directly, make that a function of the mine supply of gold, which never rises more than 1.5 or 2% per annum. So you keep base money supply under wraps. You have a market-based interest rate, and we won't have these bubbles any longer, or these massive bouts with inflation and boom bust cycles and depressions. And if we do have a business cycle contract, it'll be short-lived, very truncated, and shallow, because we won't have these massive excesses that we've engendered today through our central bank profligacy.
Very well said. I want to switch to discussing the massive amount of passive inflows that are involved in the market right now, these index fund ETFs that so many investors are in. It's being touted as the way to go. You just throw your money in an S&P fund, you buy a few bonds, you sit back, you make around 7% a year, compound that, and that's what you do. You retire after 20 years. And that's kind of living the dream, according to many financial commentators today. That still is exactly what you should do with your money. But people like Michael Green, Bill Fleckenstein, they point out that these passive inflows have fundamentally changed the way that the market operates, and they present a much greater danger than most market participants realize. So I guess a couple questions here. One, could these passive inflows cause the market to remain overvalued for longer compared to historical norms? And secondly, what could the aftermath be of all of that unwinding? And could that make kind of the hangover worse? Could the party go on for longer, but the hangover is worse at the end? I'd love to get both your thoughts, Steve. I'll start with you.
Well, the you can get bubbles, of course, no matter what kind of regime, whether it's passive or active. We've experienced those bubbles under all kinds of regimes. The question is, well, how does a bubble get resolved? How does it deflate or pop or whatever might happen? And the only thing we know is that they can't go on forever because you have the relative return on asset classes. I mean, stocks versus bonds. Now, Michael alluded to this earlier when he talked about the negative equity premium. So that or zero, whether it's negative or it's very tiny and unusual. And when that happens, that means stocks are overvalued relative to bonds, and ultimately the thing will correct itself. So if there's a bubble in the stocks, that means it will correct itself, and your rate of return on stocks is going to be less than expected going forward. So I'm very much for the reversion, because there are different big asset classes, and you can't get one of them that's out of whack for a long period of time, because people will go into the other one.
And Michael, your thoughts?
Yeah. So Greenspan started this, what I call inculcation, to teach by repetition over and over that the Fed was going to bail out the stock market. It started in 87, and we had 2000, 2008, and 2019, the repo crisis, and then you had, 2020, and then you had 2022. So, I don't go over every correction, but now the zeitgeist of today is that, hey, just buy and hold, passive flows. So you go to work and you fund your 401k plan, and that's a passive flow of money going into the stock market. And on the other side of that is active management, right? So the passive flows are increasing as employment grows, and the people on the other side is decreasing, the active managers. So what happens is finally you get a recession, and what happened is the unemployment rate spikes, and then the stock market begins to plunge. And then people call their 401k plan administrator and change their allocation to automatic buys every single month to redemptions and going into cash. You have a magnificent, unprecedented bubble in the stock market because of those passive flows and that inculcation from our central bank. And by the way, as those flows come into the stock market, they go into these cap weighted and market weighted averages, and the concentration gets bigger and bigger into those mega cap equities. So it's not only a bubble, but it's a concentrated bubble. And there's a tremendous vacuum that's created there. That will happen once we have a recession, once the flows go into reverse, and then you get fear, and then you change your allocation to your 401k, how that money is distributed. You get redemptions and you get changes in your allocation. And it could happen very quickly where you could have a drop that will only be saved by the circuit breakers that are in place on the NYSE. I think they're 7% for a little while, and then they go to 13% per day. But you only can be down 13% so many days in a row, and then you close the exchange, and then all of a sudden you're down 50% before you know it. That's what I think is going to happen. That is what we have set ourselves up for, unfortunately, in this country. And indeed in many parts of the globe.
Well, I'd love to discuss gold here, seeing as we have now crossed $3,000. I believe that's still a nominal all-time high. I'm not sure if adjusted for inflation, that's a real all-time high at the moment. But a lot of people I speak to, no surprise here, this is a resource investing channel. They believe gold is going much higher and we're in the early stages of a precious metals bull market. I wonder what both of your opinions are now that we've crossed 3,000, an important number psychologically, perhaps, for the retail investor who might not have been interested in gold and perhaps could be looking at it now. How are you viewing the gold market at the moment? What are the main catalysts that brought us here? What stage do you think we're in of this gold bull market? Or do you think we're perhaps overbought here and due for a correction? Steve, I'll start with you.
Well, you can recall, Jesse, the last time we spoke, which was several months ago. I've been in the bull market for almost since the beginning, and I think we're in a bull market, and whether it's early stage, middle, or late, I don't even care. It's a direction of things. It's like Michael. He's talking about the stock market. He's got some very precise numbers and so forth. Which the thing I don't know about the magnitude of the downdraft. The only thing I know, I'm in the same direction as Michael. It's going down. Now, exactly where it's going, I don't know really. Now, if you turn it around and look at gold, all I know, it's going up. And the reasons for that, I think, are that we have a lot of central bank buying now because of the weaponization of the US dollar due to the stupidity of sanctions that have been placed here, there, every place. And US policy is driven this. And now we have something else. We have what I call regime uncertainty coming into the picture, where we don't exactly know what Trump's going to be doing. We know he's going to have tariffs, and as Michael said when we talked about tariffs, he said, well, the implementation's been bad. Well, we don't know how they're going to be implemented, because one day they're going to be this way and the next day they're going to be another way. So this regime uncertainty comes into play and is important. And for people to think about what does this mean? It means the whole regime is changing, and people don't know how it's going to change. We had the same thing with FDR and the New Dealers back in the day. And we had a lot of regime uncertainty because they had all kinds of government interventions. Taxes were being changed, regulations, interventions, new agencies, confiscation of gold. Everything was changing. And the propaganda, of course, was that the New Dealers were making everybody feel happy. Remember, happy days are here again? Well, it turned out, no. Businessmen and investors were absolutely in a state of panic over where the regime was going. And they hunkered down. And that hunkering down actually made the Great Depression elongate. It lasted a lot longer than it would have lasted if we hadn't had all this regime uncertainty and intervention by the New Dealers. So that's a real problem that we have right now, and I think that is something that is fueling the gold market. So central bank buying and diversifying their portfolios to get away from the weaponization thing, that's going on. The regime uncertainty is going on. And now we have all of a sudden, for the first time in a long time, a physical shortage in the United States. And people going into physicals. people want physicals. They don't even want paper gold anymore. So things are changing in the gold market quite dramatically, and it looks like there's some possibility we'll have the price discovery process and everyone focusing on physicals and not futures and forwards. So it's all fuel for the bull.
Michael, your thoughts on the gold market?
Yeah, so the most important function when it comes to the future price of gold is the level of real interest rates. So the Fed's hands are tied because, as I mentioned, inflation's stubbornly stuck around 3%. And you have falling nominal rates, so real interest rates are falling. That's the strongest impetus to higher prices in gold. And then you have things like rumors that the Treasury is going to revalue the gold on its balance sheet to $3,000 an ounce from where it sits currently, which is very, very low. I forgot the number now, but I think it's like
$42.22.
$42. So if it gets revalued, it's an automatic seven. Now, first, and this is where it gets really crazy. So if the Treasury revalues its gold to what would be about $750 billion if they revalue its gold, somehow that entitles the Fed to then hand the Treasury $750 billion in the Treasury general account, which would be a massive QE program. I don't know if that's going to happen or not, but the rumor is out there. I keep hearing it. I have no insider information on that whatsoever. I think that would be a really bad thing to do. But who knows with these maniacs? I also thought handing trillions of dollars out to people so they can stay home and mail them, a total of $6 trillion of checks in the mail is a really bad idea too. So what do I know? So there are other reasons too. The end of the dollar is the world's reserve currency. If you do end our trade deficit with overseas nations, then you're also reducing your capital account surplus, which means there'll be less dollars that foreigners need to hold, and would be less recycled into our bond market and into our treasury complex and into added dollars and into gold. So gold is replacing the dollar as the world's reserve currency, and I think Steve mentioned sanctions too. It's just if you have your trade deficit recycled into dollars and held in the United States, and then the United States doesn't like you anymore, and then says, we're freezing your assets. That's a really bad deal, rightly or wrongly. So the calculation is, hey, let me hold my savings in gold rather than dollars. So those three functions, I think, are really placing a strong bid, and an enduring bid in gold, and I think it's going much higher over the years.
So one thing Michael said that's interesting. Well, he said a number of things that are interesting. One thing is that the real interest rate coming down, of course, gives wind to the sail of the bull market. But thinking about it, the real interest rate, we've had the bull market running up in the face of a lot of headwinds from high real interest rates and a record strong U.S. dollar. A strong dollar is usually a huge hindrance to gold, and so are high real interest rates. But in the face of those two headwinds, gold has actually gone up.
I think that's a great point, Steve. So that shows you, I mean, you don't disagree that falling real interest rates are great for gold.
Oh, I totally agree.
Yeah. So that means I think the gold market is like all markets is a forward predictor. And I think that these massive deficits, you have $2 trillion deficits in peacetime and in prosperity with near record low unemployment rate and record tight spreads, credit spreads at record tight spreads. Gold is telling you that the problems of debt monetization have just begun because we have no other alternative. We are going to default on our debt. And we're not going to explicitly default on our debt. We're going to implicitly continue to, and in greater magnitude, default on our debt implicitly, which is through inflation. I think that's one of the big drivers. A protracted driver of the price of gold is that we just have a deficit that's $2 trillion. The debt is $36 trillion, 125% of GDP and rising. There's no way around it but to monetize that debt. And that's a sustainable bull market in gold.
Well, gentlemen, this has been a fantastic conversation. Before I do let you both go, Steve, tell us about your latest book and where people can get it, and anywhere else you want to direct people online, feel free.
Okay, actually, there are two books that factor into what Michael and I are talking about. One, Paul Gray Macmillan published something that I wrote with Leland Yeager, great economist and polymath, called Capital Interest and Waiting. So that's one. And number two, I co-authored with Matt Sakurhi. It's called Making Money Work. That will be issued by Wiley April 29th. So you can advance order the thing online, and obviously the Capital Interest and Waiting, the Paul Gray Macmillan is out there. You can get it. And if you want to follow me on Twitter, it's at Steve_Hanke.
Great. Well, I'll put a link to Capital Interest and Waiting where people can get that, as well as your Twitter handle. Michael, tell us about Pento Portfolio Strategies and anywhere else you want to direct people online.
So the website is pentoport.com, and on it you'll see a podcast called the Midweek Reality Check. It's a 5-week free trial. It's $50 a year if you like it. I give you a 36,000-foot view of the data that most mainstream financial media won't cover, or if they do cover it, they have the wrong interpretation of the data. And if you are a U.S. citizen and you are suitable for the portfolio and you have $100,000 to invest, I will invest your money in the inflation, deflation, and economic cycle portfolio, which is based on the second derivative of inflation in the context of growth. And it is designed to make money in bull markets and designed to prayerfully make money in bear markets, protect and profit from what I call the grand reconciliation of asset prices, which I believe is inevitable to occur.
Fantastic. I'll put a link to Pento Portfolio Strategies in the description as well. Gentlemen, it's been an honor. It's been a blast. I feel like I just sat in on a master class on economics. So appreciate it, and hopefully we can do it again.
Great. Thank you.
My pleasure. Thank you, Steve and Jesse.
Yeah, good to see you, Michael.